And you guys are off for a week to chill out, get your wits about you, get refreshed. That's what spring break is all about. Guys, we're going to be moving pretty quickly today because I want to get through this chapter so we can at least start a little bit of new material on Friday. Guys, here's what's up. I have added in all the bonus points from the first guest speaker that we had this semester, so those should be showing up on your exams. I have to get one more piece of paper from somebody, literally a piece of paper, to check in on the second guest speaker. If you think I've got something wrong on your grade, let me know by class on Friday, but take a look. I'm in process, too, of grading any resubmissions. A few folks were redoing assignments based on my request, and I'm doing that as we speak. Now, last Friday, we had Career Services in here talking about Handshake. Some of you already have Handshake. That's totally cool. If you missed class on Friday, whether you're traveling for competition or traveling for school or whatnot, I sent an email out to anybody who was not here on Friday to give you the opportunity to meet with Career Services. Because I want to give everybody an opportunity to get this done. I moved the due date. The original due date to have a Handshake profile set up was this Friday. I've moved it to next Friday. I know that's during break, but that means if you want the extra time, you have it. If you want it done before you go on break, get it done. You don't have to submit anything for this. You just have to do your profile. When I log on to the system, Handshake is a separate system, I'll see whether or not you have a profile. Feel free to reuse anything you like from your LinkedIn profile. If I gave you a good score on LinkedIn, why not reuse that information? And guys, our next assignment in this class is going to be due is the rate of return assignment, which is due on the 11th of March. So we'll be going through that again when we get back. It's important that you understand how the rate of return works. And guys, today we're going to be finishing Chapter 19. If we get done with Chapter 19 with enough time at the end of class to allow us to break into groups, we're going to do that. If we don't have enough time to break into groups at the end of class, we're going to come back to the first part of class on Friday. Any questions, guys? Because we're going very quickly in the midterm. Guys, if you have nothing in front of you, if you just have a phone in front of you, pull out something to take notes with, because we're going to be talking about things that will help you do good on the next exam. So please take notes. Guys, our stock teams I've listed as follows. I think I got them all correct. The only one I was curious about, Anthony, did I put you in the right group? Okay. Because some of the emails did not have everybody's names on them, and I did what I thought was right. Take a quick look. We got groups: Woodstock, Belfort, Stock Market Bandit, Showtime, Black Mamba, International Group, and Top Stock. If I got you in the wrong group, email me and let me know. I will fix it. I love some of these names. I can't wait to see where you're going. Yes, sir. What's that? Oh, I guess not. You know what? You sent me the email and you weren't on the list. I'll add you on. Will you email me and remind me to do that? Excellent. Anybody else I missed out on? All right. It's a lot of information moving around here, guys, so bear with me. All right. Let's talk a little bit about buying stock on margin. Guys, what's bad about buying things on credit? Somebody tell me what's so terrible about buying things on credit. Yes, sir. You do. You have to pay it back later, and you might not have the money. Yes.
So you don't pay back inside time or extra accumulates?
Yeah, you got to pay interest too. Well, when you're buying stock on margin, it means you're buying stock that may or may not appreciate in value. You're doing a down payment. You're basically buying, saying, I'll pay for the rest of this later. Well, if I buy stock on margin, for example, and the stock is going for $4 a share, and I've got enough to buy $2 a share, and say I'll pay for the rest later for the original purchase price, that's great if the stock goes up in value. It's not so good if the stock goes down to 50 cents in value and all of a sudden I owe more than the stock is actually worth. So when you're buying stock on margin, it means you are basically borrowing money to buy stock, hoping that the value of the stock goes up. We're going to be talking a little bit about how to understand a stock quotation, because you guys are going to be using different ways to monitor your stocks. How do you know if a stock is good or bad? We talked about some of these terms, for example. Why might you want to look at a stock over the last year to see how it is performing? Why might you want to look at the last year of a stock? Yes? That's exactly right. Is there a stock, for example, who might go and appreciate value, say, around October, November? Do you think of one maybe that would appreciate that time of the year? Yes, yes. Apple, and it's a good guess. Why is that? Yeah, people are anticipating there's going to be something hot in the markets. What about retail? If you're a retail store and you're anticipating to have a good Christmas season, for example, people may be excited about that as well. So you want to look at the trends. For example, if you run a vacation resort that's owned by a group that's publicly traded, when do more people go on vacation? What time of year? Yeah, so there are going to be trends around it. So we're also going to look back, were there dividends paid? Is it a legal obligation to pay a dividend? No. Sam's right. You don't have to pay a dividend. It's not a legal obligation. But if you're looking to make money in the markets and you want to get some regular income from your stocks, you want to see if they've been paying dividends. You also want to see in terms of the yield, how much was it? In terms of the price and earnings ratio, what was the difference between what people were paying for the stock and what they were making? How much were they making per share? You want to see if this stock is actually making money or not. So let's take a look at an average stock quotation. Now again, this is off of Yahoo because that's what I happen to use as an aggregator. Right now we have two colors. Unfortunately, if you're colorblind, it might not make sense. Red, is that a good or a bad color in the money world? It's a bad color, man. We want to be in the black. Or in this case, in the green. If we have green, green means gain. Red means loss. Right now, for example, Microsoft, at the time we took this screen cap, was trading for $20.19 a share. It was down. We can see here from the previous close, yesterday, when it ended its day, it ended at $20.24 a share. So we're down from what we had yesterday. Today, so far, the high price has been $20.40. The volume means how many thousands of shares are trading. It's 19.98, or millions of shares, actually. That's the volume right here. And then in terms of, if we even look at the time of day, or this one is by year, for example, we've got what times of the day the stock was up, what times it was down. There was a dividend that was paid last quarter of 52 cents on this, and you were making about $1.74 a share. This is all information. If you get into Finance 202, you're going to see all the time. The bottom line is you want to see how your stock's been doing. What have the trends been? Is this a money maker or not? If you can understand that little bit of it, you've got something you can pick from. Now, how do we research stocks? Well, obviously, I showed you how you can use something like Yahoo Finance to get into any articles you want. But if you're reading Bloomberg, if you're reading Forbes, if you're using something even like news.google.com and looking at the finance or business sections, you're going to be able to see what stocks are doing well. How the market's been doing the last 48 hours, guys. Why is that? Yeah, and so we've got this whole fear, guys, that we're heading for an economic slowdown. Is the coronavirus slowing down? No. I mean, we've got thousands of cases in Asia. It's spreading into Italy. It's spreading into Europe. So all of a sudden, we have this situation where our supply chains can be disrupted. All of a sudden, if you're General Motors, for example, and you're making trucks, where do parts for those trucks come from? China. They come from China. They come from Japan. They come from all over the place. So we got a lot of parts that are coming from a lot of different places. So that's why you should keep in touch with the news, guys. That's why you should care. So in terms of investing in stocks, we talked about a lot. If we're deciding to invest in a bond, what are some things we should think about? Leroy, what would you think about before you invested in a bond?
I look at the
I'm sorry?
I search the bond.
I would definitely do some research on it. What's something you'd be interested in if you were interested in lending somebody money? Let's say, how are they going to pay you back? But let's also talk about, let's compare this again. We got Lauren and I. Lauren's got great credit. She's like one of these people who always pays people back, and I stink at it. Man, you lend me money, sometimes I pay it back, sometimes I don't. John, you're going to lend Lauren or I money. Who's going to pay a higher interest rate? Oh, she's going to pay a lower interest rate, man. She always pays it back.
Oh, I'm saying like in real life.
Well, we're talking, you don't know my credit score. You know,
You're an all you bought things. Like, you don't have credit score, you didn't buy anything.
It's true. It's true. I tend to be very careful with my money. But hypothetically, if my credit sucks and Lauren's great, she's getting a lower interest rate because you want to make sure you're getting your money back. So, in terms of assessing a bond, what we're looking at is what's the likelihood you're going to get paid back? What's the likelihood that this is a high risk? The higher the risk, the higher the interest rate. If you like playing the markets and you like risk, junk bonds might be for you. We covered this before, but I want to make sure you understand what this means. Guys, we've got several groups whose entire reason to exist is to assess other companies. So we have Moody's, S&P, and Fitch. These are finance firms who basically assess people's financials. Using Laura and I as examples here, let's say, what might be some indicators of why Lauren's better able to pay back her debt than I would? What are things that people can find out about us that would make her a better risk than I? Yes?
Where you guys work?
Where do we work? What kind of jobs do we have? Lauren's a CEO and I'm a janitor. So we got that going on. What else could they do? Yes? Property ownership. Lauren owns a couple of ranches and a couple of skyscrapers. I own a trailer on the Crescent Road. It's easy to spot. It says Tonkin Estates. What else might be something that would be an indicator of who's a better risk? How about our bank accounts? How about how much money we have in the bank? How much we have to be able to pay things back? That would determine if something's a high or low risk investment. If you get past a low risk or a high risk of BA/BB, if you get BA/BB or lower, that's junk bond territory. Junk bonds pay high dividends. With me so far, guys? So if you're a risk taker, bonds might be for you. If you want to know how to know what a bond is all about, guys, if we look at our current yield, that means if you took whatever you paid for this bond and divided it by the amount of time that you're keeping it, that'll give you the current yield. Your yield to maturity means if you kept this bond until it was mature. So if we were paying for our car for the whole 60 months, and we're paying interest all the time, for example, if we're paying 10% interest, take 10% plus the price of the car, that's what you pay if you keep it to maturity. And the interest rate is what we're paying. That is basically how much interest is somebody collecting on us. With me so far, guys? I know this isn't necessarily exciting to talk about, but it's absolutely the way finance works. And guys, one interest point can make a big difference in the total amount that you're paying. In fact, let's talk about that for a minute, guys. The value of money. Generally speaking, if you're getting paid, let's say you're a salary employee. Does anybody know the difference between somebody who's salary and hourly? What's the difference?
When you're hourly, you get paid for every hour. So if I stay like 2 hours over and I work 42 hours, I get paid for the 2 extra hours. But if you're salary, you get paid a set amount, and no matter how much or how little you work.
That's exactly correct. And you get paid a time and a half if you work overtime if you're an hourly employee. So if you work 42 hours, you take those extra 2 hours times 1.5. That's how much you get paid. So I'm a salary employee and you're an hourly employee. When you get a raise, let's say, for example, somebody is saying, hey, we're going to give you a $1,000 raise. What does that actually translate to in your monthly income after taxes? Any guesses? Like, it sounds awesome. If my boss walked in there and said, Tonkin, you're doing a good job. I'm giving you a $1,000 raise. What would that actually give me a month? It's not very much at all, because it translates to, if you take somebody pull out their calculator, take 1,000 and divide it for me. If I get paid twice a month, 1,000 divided by 24, what is that? Yep, that's before taxes. So if you take it down, you're making about 20 extra bucks a month, or 20 extra bucks a paycheck, not even after taxes if somebody gives you a $1,000 raise. That's where 1,000 sounds like much, but it isn't. However, one extra interest point, if you go from 7 to 8.5 or 9%, 1 or 2 points, makes a big difference in what you're paying for a vehicle, because the interest adds up every month. Does that make sense, guys? So know the value of a dollar. Guys, if you're getting into bonds, I don't care that much about this aspect other than you hear it on CNBC. Does anybody here watch CNBC once in a while? Ever? Okay, yeah, it's good. It's a good place to go if you're watching Jim Cramer and Mad Money, for example. It's not a bad place to get into the investment. You'll hear them quoting this stuff all the time. They basically, say for example, we have a 9% bond due in 2022. They call them 9s of 22. That's just some of the speak they use. If you ever hear that on CNBC, that's what they're talking about. So they do it in percentages. Bonds are good investments, though. Guys, before we move into mutual funds and ETFs, are there questions about stocks or bonds? I'm going to quiz you real quick. I want to see what you know about this. Of the two investments, stocks or bonds, which one do you legally have to pay back? Bonds, exactly right. Can you legally be required to pay dividends on a stock? Correct. If I could have two kinds of stock, if I could have preferred stock or common stock, which one gives me voting rights in the company?
Common stock.
Common stock is correct. Guys, in terms of generally speaking, although there are exceptions to this rule, if I have stocks or bonds, which is a more risky investment?
Stock.
Generally speaking. Very good, guys. Can you buy a partial share of a stock? Cannot. You cannot buy a partial share of stock. That's why when you're doing your portfolios, you have to divide that $100,000 by the number of shares you can actually afford. Now, you cannot buy partial shares of stock. You can, however, buy exchange-traded funds. And I'm going to explain what the differences are here. When we get into talking about things like mutual funds, how many of you ever heard your parents stressing out about their retirement? Nobody? Wow. That's good. That's good if your parents aren't stressing about it, because most of your parents are investing in things like mutual funds. What that means, guys, if we wanted to have a mutual fund, instead of all of us going and playing the markets, we're all pulling our money together and we're all investing together into the stock market. Hopefully we've got somebody smart who knows the market who can invest on our behalf, and we all benefit from it. Most people, for example, in their retirement aren't actually playing the markets. God help us. If we have people who don't know the market, who are investing, they can lose everything, man. It's happened. So we get into what we refer to as mutual funds. And most of us in our retirement invest in mutual funds. So a mutual fund is a way to pull all your money and put it into an investment where you know somebody else is managing your money well. Now, I have said repeatedly that there are no ways to buy partial shares of stock. This is an unofficial way to get a piece of the stock. How many of you are carnivores in here? How many people eat meat in this classroom? All right. Does anybody like hot sausage? I love hot sausage. Can anybody tell me how do they make sausage? Does anybody know how they make sausage? How do they make sausage?
Like ground meat and animal pressure.
Exactly. We get a couple different kinds of animals. We grind them together. For example, if you get Italian sausage, it might have some beef in it. It might even have a little bit of pork in it, depending on where you're going and what kind of sausage. It probably have a lot of pork in it. Just like hot dogs have different kinds of meat in them. ETFs are basically financial sausages. Here's what I mean by that. We're taking a piece of this stock, we're taking a piece of this stock, we're taking a piece of this stock, and we're packaging it like a delicious Italian hot sausage. Love Italian hot sausage. And we can sell that. You can buy shares of ETFs. So although you can't literally buy a partial share of stock, you can get a partial share that was bundled into something called an exchange-traded fund, and you can basically buy an amalgamation of stocks. Again, think of it as sausage made out of different parts of stocks. Does that make sense, guys? And by the way, guys, if you ever knew what was in some of the things we eat, you probably never eat them. How many of you still like hot dogs? Oh, I still eat them. I know what's in them. Is a hot dog a sandwich, by the way? Is that? I've heard that debate. What do you think? By show of hands, how many of you say a hot dog is a sandwich? How many of you say a hot dog is not a sandwich? Well, somebody who's taking the position that a hot dog is a sandwich, will they back up their point? We're talking about sausage. Yes?
You put it in a bun.
It's in a bun. I agree with you. There's carbohydrates wrapping that thing. Somebody who says a hot dog is not a sandwich. How so?
Say I'm eating a hot dog. You don't say I'm eating a sandwich. It's just a hot dog.
It was a hamburger sandwich.
Burger.
So where's the line between
If you call it a sandwich, it's a sandwich. You don't call it a hamburger sandwich.
So like a ham sandwich is a sandwich, but a hamburger is not a sandwich.
You don't call it a hamburger.
You don't call it a hamburger.
I'm distinct enough.
You don't call it a hamburger sandwich, but if it's between two pieces of bread, it's a sandwich.
It's a bun.
Like a peanut butter jelly
It's a
sandwich.
bun. Just
Peanut
like a hot
butter
dog is a bun.
and between two buns and make it a sandwich.
Bro, peanut butter jelly sandwich is a peanut butter jelly sandwich. You say
Wow.
sandwich.
So what's the difference between a peanut butter jelly sandwich and a hamburger?
It's on a bun in a sandwich. You just said a hot dog was on a
I
bun.
think two pieces of bread make it a sandwich.
But you just said a hot dog was
Hold on,
on a
man. If I get a ham and cheese sandwich,
Bread like
if
this.
I get a ham and cheese sandwich that's on a bun, it's still a ham and cheese sandwich, and it's on a bun. What's that?
I'd argue it's not. I think the bun is not really just going to make a sandwich.
Yeah, the bun makes it something else.
That's a whole different story. It's distinct enough that they have different words for them. So like,
Wow.
So it's a hamburger. It's a hamburger.
But I've seen menus and it said like hoagie sandwich, right? I've seen menus and it said like hoagie sandwich. If that's the case, and a hoagie is in something like this, the same way how a hot dog is in something like this, don't that mean the hot dog is a sandwich?
But you just said a hot dog was on a bun. It's not a sandwich.
What?
You just said that, bro.
No, I didn't.
Bro, you didn't say that, bro.
Hold on though. If you go to a menu, they list all of these things as sandwiches. Like, well, Popeyes, for example, they call it a Popeyes chicken sandwich, and it's on a bun.
I think that's the
Oh, damn. We got you. Yeah, what you gonna say? Yeah.
Yeah, so
It's called a chicken sandwich. You don't call it a hamburger.
It was. So then what's the line? Go ahead. What's the
where is the line here? That's my question.
If it's chicken, then it's not a burger.
Yeah, like a
It's
burger.
different. It's a hamburger, and then there's like chicken sandwich on
Yeah,
the bun.
it should be a chicken bun.
Separate.
So if a chicken's on a bun, it's a sandwich. But if a hamburger's on a bun, it's a burger.
Exactly.
So if a burger was called a meat sandwich, it would be a sandwich?
No.
Wow. I had no
It was called that,
idea.
yes, but it's not called that.
Wait, boy. Why would it be? So you trying to tell me it's from what it's called, not what it
Bro,
is?
you're a hypocrite. You just said a hot dog. You just said a hot dog was on a bun. That doesn't make it a sandwich. No, a hamburger.
I didn't say that, bro.
You did say that.
I said a hot dog, bro. This whole time we're saying a hot dog is a sandwich, bro.
Cap, you said,
Yes, bro.
you
I
said a
said
hot
it.
dog is
Bro,
on a bun.
if,
This
look,
first
if a
argument.
hoagie's a sandwich.
Here's how we're
And
gonna
a
settle.
cheesesteak is a sandwich.
Here's how we're gonna settle this, guys. Here's how we're gonna settle this. We get two people. No, listen up, guys. We get two people the first day back from break who are willing to take either side of this argument in the front of this room and duke it out for 10 minutes. There's going to be. You volunteering? All right. Which side are you taking?
You don't even know. No, you're not volunteering.
So we got hot dog is on a sandwich.
All right, just because it's him, I'm gonna go hot dog is a sandwich. It's me. I want that.
All right. We got these guys back here that already claimed the route. See me after class. We're going to set this up. First day after class, it's on. All right. Wow.
What am I saying? What is that shit?
Good way to like end.
You're not gonna say
end
nothing
the
real.
first spring break. You should do it Friday.
You think? Will you guys be ready by Friday? See, all right. Suggestion taken. We're starting class on Friday without debate. All right. But guys, we got to jump back in. I'm dying to know how this is going to turn out. Wow. All right, guys. Let's continue. In terms of why so many people own mutual funds, if we look back to the 80s to now, I know this is not necessarily something that applies to you guys, but let's think about this for a second. Who here has ever heard of the word pension? Does anybody know what it means?
I know that.
What's a pension?
It's like something you get right before you're about to retire, right?
Exactly correct. And here's the deal. In the old days, companies provided pensions. So let's say, for example, I worked for Bethlehem Steel in Pittsburgh, Pennsylvania. They paid into a pension, so when I was ready to peace out and go into retirement, they hand me basically a monthly income that they take care of. Well, here's what happened. That was dependent on the companies being solvent and the pension companies being solvent. Over time, more employers have been saying, we're getting out of that. We don't want to handle this. We want you guys to deal with your own retirement. And we look now, for example, we get into the 2000s and even now 2010 to 2017. I would argue that number is probably going back up. Most people are investing in their own retirement. By show of hands, how many of you don't believe Social Security will be there when you retire? Oh, how many of you do believe it'll be there? How many of you don't have an opinion yet? It's okay. Here's what I'll say to you guys. I don't believe it's going to be there when I retire, let alone when you guys retire. The system is going to implode and crush itself. By the time you guys retire, do you know how many people will be working for every person who's retiring? Two. 2 people will be working for every person that's retiring. Right now we've got 7 or 8. That system cannot hold as it's wired in. That's why we care about investing in our retirements. Well, we talked about exchange-traded funds. Basically, you can invest in something that's traditional, like the U.S. stock market. You can go into a niche. You can go into a particular food industry. Or you can even go into something like green energy. I don't care if you really remember that part. What I do care that you remember. In fact, I would write this down. ETFs are equivalent to security and finance sausage. I'm serious. Write that down. That's going to be a question on an exam. I'm telling you bluntly, write this down. If you don't have something in front of you to write with, write this down. ETFs are the equivalent of financial sausage because it's the truth, and it's delicious financial sausage. Guys, if we're getting into mutual funds, however, what you're basically looking at here is per share, what is that fund worth? So, what's that? I can. Yes, sir.
Just you backtrack real quick. I just looked up and they said yes, a hot dog is a sandwich because it's in a roll.
Oh, we're stoking the fires here. All right, you guys good? Do you need to slide up for another minute? Or are you good?
Good.
You guys good? All right. Well, here we go. In terms of mutual funds, basically, you are taking a per share price based on how many people own shares, how many shares are outstanding. That'll mean the value of the shares in the mutual fund. All I care that you know about mutual funds is that it's pooling investments and investing them on behalf of the investors by people who know what they're talking about. Yes, sir.
Never mind.
No, go ahead. What?
I just searched on Google. Hot dogs is a sandwich.
Hey, Google can be wrong sometimes too.
Yeah.
Google can be wrong.
No, their reasoning was because it's in a roll that makes it if a hot dog by itself is not a sandwich, obviously, but if it's in a roll that makes it a sandwich.
Man, what have I started here? It's awesome. You guys are passionate about this. So I feel,
a sandwich?
I'm sorry?
A sub is a sandwich, a hoagie is a sandwich, a cheese is a sandwich, all of it, because it's in a roll.
I have to admit my bias on this one. I like general categories. So to me, if it's meat or spread or whatever on some kind of bread or roll, to me it is a sandwich. That is my bias, but I can't wait to see the debate play out.
He's not going to win.
Yeah, it's possible.
He don't want to win, he just want to talk.
Yeah, he just want to go in front of the
Great. I love it. Guys, in terms of if we're comparing investments, for example, we all know that, for example, bonds are going to be your lowest risk investment. Will somebody here tell me why bonds are your lowest risk investment? Yes.
Your money's spread out. It's not in one place. So like, if you don't all your eggs in one basket, like if something goes wrong, maybe like a couple, but it's spread out.
So having a diverse portfolio is good, for sure. Is there another reason? That's absolutely true. Yes. Because they legally have to pay you back. Bless you. If you've got preferred stock, it's less risky than common stock because you get your dividends first. Common stock, mutual funds, ETFs all have variable risk. You can't make a blanket statement that one is completely less risky than the other, but generally speaking, bonds are less risky than stocks. Stocks and derivatives of stocks have different levels of risk. Again, if you go for an exchange-traded fund, if it's made up of all high-risk stocks, it's going to be a risky investment. If it's made out of a diversity of types of stocks, it may be less risky, for example. Guys, we monitor the markets with a couple of different I refer to them as thermometers. We've got the Dow Jones Industrial Index, we've got the S&P, we've got a couple of companies. Standard & Poor's, by the way, is what S&P means. Same company that does bond ratings. These are companies that basically monitor the performance of key stocks to see how the market is doing. Who here could tell me a company, in terms of an old company in the United States that's been around for a while? Something that's been around and still around. Yes. Oh, that's a great example. Privately owned, by the way. It's been in the family the whole time. Are you from that area? Yeah, man. I actually did a couple of tours of the England brewery. I used to teach a class on fermentation, on beer making. And our field trip was to go to England. It was amazing. It's the oldest brewery in the United States in Pennsylvania. And guess what? The next generation is going to be female owned. So the oldest brewery in the United States, or I shouldn't say the largest, but the oldest brewery in the United States is going to be owned by a female for the first time in history. Very proud of the England Brewing. Well, tell me another company that maybe is more nationally focused that's been around forever. Anybody think of a company that's been around forever? I'll give you a hint. They make a lot of different kinds of cars. Ford's a good one.
Is it Dodge?
Well, Chrysler, that's another one. Yep.
Is it GM?
GM is another one. All these companies are kind of watermarks for how we're doing. So in other words, there was an old expression that used to be, what's good for General Motors is good for the country. And what that meant was, if GM was doing well, actually let me ask you guys, if GM is doing well, if they're selling lots of cars, what does that say about the rest of our economy? Yes. People got money to buy cars. People have money to buy giant pickup trucks, all these things. So GM is a company that we keep a watch on. Whether you're talking about the Dow Jones Industrial or the Standard & Poor's 500, we look at a variety of stocks to see how our economy is doing. Now, it's funny, if we look at the original companies that were listed on the Dow Jones, that was 12 companies originally. We're talking about American Cotton Oil. This is back in the 1800s. General Electric, National Lead, U.S. Leather, all these companies that were listed on there. And guys, the text is actually a little out of date because of the current Dow companies. There was a company that recently left, and that company is General Electric. General Electric was Thomas Edison's big company and was one of the first American industrial powerhouses. Recently left the Dow because the company is becoming increasingly less relevant in our more diverse economy. So that was the oldest surviving company on the original Dow that was still there, and they just left it. So we've had plenty of times in the markets, guys, we're up and down. When we start talking about Black Tuesday, October 29th, 1929, what was that the beginning of? When the markets crash. Absolutely correct. The Great Depression, during that time, 1 in 4 Americans could not find work. Guys, it was a bad time to be in the States. People were depressed. People were suicidal. When the bond market crashed and when the stock market crashed, people literally were throwing themselves out of buildings. Then we get into 1987, which was I think I actually referred to that as Black Monday, if I don't remember that exactly correctly, but we lost almost a quarter of our market value in a day. And then we get into the late 90s, whenever the dot-com bubble was starting to burst. Guys, the reason I put these dates up there is the market goes up and down. Like right now, we've had 2 days of bad trading, for example. We've had 2 days where people are not excited about the markets. We'll come back. We're going to go down again, too. If we look at 2008, does anybody remember, guys, about how much value the market lost in 2007, 2008? Remember a general percentage? Anybody remember we talked about it in class last week? It was high. It's about 45%. Guys, if you want to know why so many older people are still working, it's because the market's lost so much value. You just pray to God that when your time comes to retire and you're able to take your money out of the system, that you're retiring at the right time when the markets are good. So again, the financial crisis of 2008 started here in the States, and it was all because of what was going on with real estate. If you don't have a tolerance for risk, if you don't have a tolerance to be able to deal with uncertainty, the markets are not for you. So if you're planning on investing in the market, if you're planning on playing the markets, know your level of risk before you get in. In terms of the Wall Street that we're investing in these days, one of the most interesting parts about it, if we take Uber, if we take Lyft, you pick your company, Casper Mattresses, they have one thing in common about what is it, other than their quote-unquote tech economies. What does Casper, Uber, and Lyft all have in common? It does not make for a good business model. Any guesses? Has Uber ever been profitable? No. Lyft has not been profitable. Casper has not been profitable. So we're talking about investing in companies that have not yet turned a profit. For example, Amazon, for its first 15 years of existing, did not turn a profit. So why do people still keep throwing money at it? Why would you invest in a company that wasn't making money? They were hoping that the ideas would eventually turn into something. I mean, would you agree with me that in terms of online retailers, Amazon's top dog in the States right now? For sure, but it took them a long time to get there. People are hoping, if you're investing in Uber, if you're investing in Lyft, that eventually those ideas are going to take such root that they're going to kill everything else. But the question is, how long will the investors stay on board if they're not making money? Who knows? It's the economy we're in right now, the economy where companies are not immediately profitable. One of the other things that's increasingly happening too, guys, do you have anybody here who likes online auctions? Anybody do eBay once in a while? Do you guys program in your Macs in terms of automating your bidding? Do you do that stuff as well? A lot of people do. And we had the same thing happening in the 80s, and it's what they referred to as program trading. So I would basically program in when I was willing to buy a stock, at what price I was willing to pay for it. And as a result, back in 87, the big one-day market crash was because the computers who were doing this automated trading couldn't handle it. There are some people who for example, we went to the stock exchange this past Friday. The broker had a very interesting perspective. He said that he felt that computerized trading was a bad idea. He felt that in the long run, you still need to have people in the equation so that things like this didn't happen. So that if you could see that somebody made a mistake in the system and bought too many shares of stock, that it could be fixed. Unfortunately, that's not the way we're heading. We're heading to greater levels of automation. I would be surprised in your lifetime if we did not see a completely algorithm-driven stock market where people were basically automating most of their trades. I've been wrong before, I'll be wrong again, but I think you'll see it in your lifetime. So in terms of what this turns into, guys, we're talking about market bubbles. The last one was real estate. I'm going to tell you what I think the next two bubbles to burst are going to be. Actually, let me see what you guys think. We know that. What do you think the next one's going to be?
Automotive.
I completely agree with you. Why do you think automotive is going to be the next one?
They're just such high prices, and a lot of people have cars now that are good enough. Like when you have a 2015 car, why do you need to upgrade to a 2020 when it does the same thing? It's just as good. It's just as reliable.
People are saying, "Why my car's great? Why am I going to upgrade?" That's part of the equation. Why is another reason automobiles are going to be the next bubble to burst? Any thoughts? Anybody know what the average car payment is in the United States right now? Take a guess. This side of the room. Take a guess. Humor me. What do you think the average person's paying? Yes. Oh, go up. No guess. Yes. It's about $650 to $700 a month. I saw the. By the way, Tyler, I saw the look in your face when you heard that figure. I feel that way too when I think about it. It's like, dude, that's almost like a mortgage payment in Central Pennsylvania for real. And so we're talking people who are taking 72-month terms at $600 to $700 a month. So what happens when we get the next recession? And all of a sudden you can't make that payment anymore? What happens? Those cars get repoed, man, and nobody's paying for them. And we're talking about giant trucks and SUVs that people are not going to be able to pay for the next time the market tanks. What's going to be the next bubble after that? I'll give you a hint. It touches you guys directly. What were you going to say? I agree. I think it's going to be, the education is going to be the next bubble to burst. And it's one of these things, believe me, I don't need to tell you guys, college is expensive. As a fellow student who's taking on student loan debt, I feel your pain. I truly do. And I think we'll hit a point where people are having a harder time, especially during a recession, paying for it. So who was responsible? Actually, we'll say in terms of the fallout of 2008, but in general, who's responsible? Is it Wall Street because people made irresponsible decisions? Yeah, probably. Because people were doing things like buying stock on margin or selling and buying junk bonds. How many of you have seen the movie The Big Short? Yeah, it's the lack of ethics on Wall Street. Could it be Main Street? Could it be that people were taking out loans they knew they couldn't afford and local banks were being irresponsible? Could it be Washington not having good regulations to make sure that we were engaging in good financial practices? I submit to you that it's probably all three. So Dodd-Frank is the law that we started after 2008 that basically put more checks and balances on ensuring that we were making sure our banks were solvent, that they were giving out loans to people who deserved them and could pay them back, and put more controls on the finance industry. The Trump administration has been rolling back some of these rules. Some people are concerned that'll help us head toward another recession, but time will tell. Guys, that being said, because we did have a spirited discussion about the nature of sandwiches today, which was high on my priority list for the semester, and we're going to have a spirited debate on Friday about that, what we're going to do on Friday, after our sandwich debate, we're going to have some time for you all to meet as groups and to pick your stocks that you're going to play in the markets. Have a great day. And for our sandwich debaters, give me a minute up there.